I'm Phillip Smith, financial planner with Tidepool Wealth Strategies. And today, as a supplement to podcast episode 8 of the Perfect Retirement Plan, which you can check out here, we're tackling a question that catches many retirees off guard. What are required minimum distributions and how do they work? If we're cutting down to the core of it, it's the IRS's way of saying it's time to pay up. Here's the deal. Once you turn 73 in 2025, the IRS requires you to start withdrawing money from your tax-deferred accounts, like traditional IRAs or pre-tax money in your 401k or 403b. This is the required minimum distribution, or RMD. Now, why do they eventually require it? Because you haven't paid taxes on that money yet, and Uncle Sam and IRS and Sister State are tired of waiting. Now, depending on how old you are, you may have heard that RMDs were at a different age. Here's a brief history on that. Prior to 2020, the age was 70 and a half. In 2020, one of the pieces of the Secure Act increased the RMD age to 72, and then Secure Act 2.0 increased the RMD age again to 73, with a built-in increase in 2033, age 75, for those born 1960 or later. So as of today, RMDs start at age 73, and the amount you have to withdraw is based on two things: your account balance on December 31st of the previous year and a life expectancy factor the IRS assigns based upon your age. Now, let me show you an example. At 73, the first RMD is roughly 3.8% of your account. By age 83, it's going to increase to about 5.7%. And then at 93, well, by then it's almost triple where you started. And if the RMD is all you're taking out, your account probably grew over this period of time, so it's a larger percentage of a larger balance. The idea is that the percentage grows as you get older, ensuring the IRS gets their cut sooner rather than later. So why does this matter? Because it creates a need to plan ahead. Here's a few reasons why you need to plan for RMDs. First, RMDs are taxed as ordinary income, which can push you into a higher tax bracket. Second, if you miss your RMD, the penalty is a whopping 25% of what you should have taken. So if you sketch that out, 25% plus, let's just say, a 22% federal tax bracket. And if you're in Oregon, another 9% for state taxes. That's 56% of the distribution that just vanishes. Trust me, you don't want to make that mistake. And then third, single tax filers can experience a higher tax rate. If you are single as a result of a spouse passing away, the surprise increase in a tax bill can be pretty unsettling. There's a lot to unpack with this one, so that could get us off track for today. Maybe we have another video to discuss that in the future. And then number 4, generally money left in these accounts has a 10-year lifespan. And as you can see here in the IRA beneficiary family tree, most non-spouse beneficiaries are going to be subject to that 10-year rule, which means the account must be depleted in 10 years. And that's all taxable income. So how do we plan for RMDs? Here's how you can get ahead of RMDs and keep more of your dollars out of Uncle Sam's stack. First, start withdrawals early. Taking smaller amounts in your 60s can spread out the tax impact. Second, consider Roth conversions. Moving money from your IRA to a Roth IRA, while it does incur taxes today, could reduce your future RMDs. And third, stay organized. Work with a planner and a tax pro to calculate and schedule withdrawals so you don't miss the deadline. RMDs aren't optional, but with a little planning, you can minimize their tax impact and avoid costly penalties. If you're unsure about your RMD strategy, let's run the numbers together. Thanks for watching, and remember, the perfect retirement plan for you is the one you act on.